Hi everybody, welcome to our quarterly update from the alternatives business. I'm Sumaira Abdi and with me I have Gaurav Mehta. He's the equity CIO of the alternatives piece. So Gaurav, we meet again and in very, very turbulent times. I mean,
Absolutely.
every year we think is volatile, but this year more so. We've seen, the trade wars, and now, of course, there was this looming India-Pakistan war for a bit. But it's very difficult to predict what a leader like Trump might do. We don't know how India-Pakistan is going to shape up. But since you are the head of the asset allocation committee here at SBI Mutual Fund, how are you looking at playing this whole piece? What is the asset allocation like?
So Sumera, our belief always has been that it's always very difficult to predict short-term market moves, and which is why we fall back on an objective asset allocation framework. And this is a top-down framework that looks at valuations, earnings, and market sentiment. And I think when you look at any priced level of any security, it's a function of valuations and earnings. But I think what we also must realize is that things don't stay at fair value because there is so much of emotional investor emotions that are at work at all points in time. So in periods of exuberance, things overshoot. In periods of pessimism, things undershoot. So which is why apart from valuations and earnings, we also look at market sentiment and we quantify it to get some sense of market direction going forward. I think what's changed over the last 6 7 months, thanks to this correction, is that our readings on valuation as well as market sentiment have eased off a bit. So last year till about September, our valuation readings were very expensive, and we look at equity earnings versus 10-year bond yields. I think what's changed over the last 6 7 months is that there's been some market correction, there's been some earnings roll forward, so that's led to some PE contraction on equities. And equally importantly, and I think even more importantly, 10-year bond yields have moved down by about 60 odd basis points. I think they were 690, 95 earlier. They are now 630, 635. And this combination of a bit of PE contraction and a significant reduction in 10-year bond yields have now moved equity valuations back to historical averages. And when I say equity valuations, I'm largely talking about Nifty and Sensex as the frontline indexes. But those valuations from being very expensive are now back to historical averages. Alongside, I think the second thing that's changed is that our sentiment measure was extremely exuberant again sometime around September of last year. And that from a contrarian point of view suggests lower equity exposures. But I think again what's happened over the last 6 7 months is that because of this correction, sentiment readings have turned back to neutral, which means that now there isn't too much of greed in the markets and hence a lot of excesses have been eased out. I think both these are welcome changes, valuations turning average, sentiment turning neutral, and that suggests that now is back, that time when you go back to your long-term asset allocation. For a good part of last year, our asset allocation frameworks were suggesting underweight on equities. We are now back to neutral levels. Valuations are not outright cheap. Sentiment is not outright pessimistic to warrant a big overweight on equities, but at least you're back to neutral from being underweight. So not a time to be underweight either.
Okay. And Gaurav, on the SBI Optimal Equity AIF, it was designed to offer, Nifty-like returns, okay, over, say, a 3-year period. But this is a, portfolio which has given negative returns, right, especially in Jan-Feb period. What would you say to investors now? Is there a need for some course correction? Has it been done? Or what is the kind of explanation that we can offer to this?
So Sumera, Optimal Equity is a fund that over the long period has generated decent double-digit returns. But yes, in the month of Jan and Feb, the returns were negative. And I think, if you look at the last, that 5 months of correction from October to Feb, I think in the October, November, December period, Nifty fell a lot. Broader markets didn't. In fact, Optimal Equity was positive in that 3 month period. In Jan and Feb, I think the picture reversed where Nifty didn't fall much, but the broader markets fell a lot more. Now, when you think of optimal equity as a product, it's a mix of a top-down asset allocation and a bottom-up stock selection. On top-down asset allocation, we were conservatively positioned. I think our average allocation during that period was 60 odd percent, while we can move from 0 to 130, but we were at 60. The neutral is at 65, 70, so we were significantly lower than neutral. But on the bottom-up stock selection, our view has been that A, we want to be market cap unconstrained, and B, we usually have skew towards smaller companies because we think that over long periods, smaller companies not only do they offer higher growth potential, but also there is a degree of research arbitrage where if you identify a promising small cap earlier, you also benefit from the discovery process, and because of which I think these short term market gyrations is not something that we react to if we are convinced of the long term potential on the story. So I think what happened to long story short, what happened in the months of Jan and Feb was that there was indiscriminate selling, and the more illiquid your portfolio, the more was the sell off. So I think for our portfolio, while the equity allocation was conservative because of our asset allocation framework, the top-down stock selection was still skewed towards small caps, and as small caps did much worse than Nifty, you had a portfolio situation where when you look at that 5 month period from October to Feb, the drawdown on our portfolio was very similar to drawdown on the Nifty. Even though conservative allocation should have ideally led to lower drawdowns, but because of higher skew towards small caps, the drawdown was pretty much in line with the Nifty. But again, I think you are in an environment now where that peak climactic sell off is behind, that indiscriminate selling phase is behind, and I think investors will revert back to bottom up stock fundamentals. And on that, I think this is a portfolio which we are very convinced on because it offers significantly higher growth versus the Nifty. The stocks have significantly lower financial leverage versus the Nifty, and ROEs are either comparable or better than the Nifty. So on the whole, I think fundamentally the stock portfolio is well placed to reward long-term investments.
Gaurav, thank you very much for explaining all your alternative
My pleasure.
strategies. And I hope you found that useful. Thanks very much for watching. We'll see you again next quarter.